Hey everyone, welcome back to The Explainer. Today we're diving into the August 2026 Market Intelligence Briefing, and let me tell you, the numbers we're looking at right now are just historic. Literally on the first trading day of August, the Dow smashed right through 53,000. Meanwhile, Amazon casually crossed the $3 trillion threshold, and the Magnificent Seven, yeah, they added $1.77 trillion in market cap in a matter of 3 days. We're talking about a massive, foundational shift in economic drivers here, and it definitely demands our attention. Now, to really grasp what's happening, we need to cut through the summer noise. Scott Rubner over at Citadel Securities hit the nail on the head. He said, "The technical reset we have been waiting for has largely occurred. July did not change the structural bull market, it reset it." So, what looked to a lot of casual observers like a scary dip in July, actually, scratch that, it wasn't a dip. It was a completely healthy fundamental reset. The market was basically just cleansing itself. So, here's our roadmap for today's explainer. We're going to hit point 1, the structural reset, then look at point 2, the AI growth engine, and 3, navigating market friction. We'll pull it all together in point 4, the dual economy, and finally look ahead at point 5, upcoming market catalysts. Basically, we're going to unpack this explosive growth and the very real risks balancing the whole thing out.
All right, let's jump right into section 1, the structural reset.
Now, this transition didn't just happen out of nowhere. It played out in 3 very specific and, frankly, necessary phases. Step 1 was retail de-risking. We literally saw $60 billion drain out of leveraged ETFs from their June peak. Crazy, right? Then came step 2, the concentration unwind. This was a pretty painful $1.5 trillion wipeout in semiconductor market cap, knocking their weight in the S&P 500 from 20% down to 16%. And finally, step 3 was the fundamental rotation. Once the blackout windows expired and hedging costs finally normalized, we saw a massive shift right back into corporate buybacks. This whole cycle basically just scrubbed the deck and put us right back on a fundamentals-driven foundation. And hey, speaking of fundamentals, check out this next massive data point, 35 to 40%. Coming into Q2, the initial consensus for S&P 500 earnings growth was projected at a respectable 22.4%. But the actual growth, it absolutely shattered those projections, landing somewhere between 35 and 40%. So why did this happen? Well, there are 3 main drivers pushing this massive earnings growth. First up, rising capital expenditure. This is being aggressively pushed by hyperscaler infrastructure investments all across the board. Second, we're seeing robust revenue backlogs, which gives us some really strong forward visibility. And third, inexpensive multiples. Believe it or not, despite the broad index sitting at all-time highs, valuations are actually staying pretty attractive. Mona Mahajan from Edward Jones pointed out in the briefing that we're looking at one of the strongest earnings seasons outside of major post-recession recoveries. It's a real game changer. Moving right along to section 2, the AI growth engine. You can really think of this current AI infrastructure boom like a massive physical engine, sparking a total manufacturing renaissance. On the intake side, you've got massive AI data center buildouts, surging aerospace demand, and these unsustainably low inventories basically just feeding the machine. Inside the combustion chamber, it is running hot. The ISM PMI hit 55.6, which is the highest we've seen since May 2022, right alongside a 5-year high in the production index. Now, the exhaust coming out the back, that's persistent inflation and input costs, which, we absolutely cannot ignore. But the big takeaway here is huge. This engine has definitively ended a long stretch of industrial malaise, giving us 7 straight months of sector expansion. Let's ground this whole engine idea with some tangible commercial results. In enterprise integration, Palantir used custom data lakes to drive a jaw-dropping 149% jump in U.S. commercial sales, pulling in $1.9 billion in Q2. Visa just dropped $2.4 billion to acquire BioCatch to leverage AI for fraud detection. Snap is literally taking pre-orders for $2,000 augmented reality specs as their daily active users scale up. And over in frontier models, Alibaba's QN 3.8 Max launch is actively challenging U.S. supremacy, with Chinese AI token usage actually surpassing the U.S. by 70%. We're way past abstract hype here, folks. This is hard, tangible revenue. Now, let's shift gears to section 3, navigating market friction. As objective analysts, we have to admit we're navigating a pretty uneven landscape right now. On the winning side, you've got leaders totally riding the fundamental and AI tailwinds. You've got the mega-cap tech space where Amazon just breezed past $3 trillion. BP is posting surging profits from elite energy trading, even while their broader sector lags. And Pelagos just locked in an $18.8 billion industrial real estate acquisition. That signals massive confidence in infrastructure. But on the flip side, the laggards are facing some serious friction. Hospitality is getting hit hard, with Marriott shares dropping 7%, tied to slowing Middle East construction and geopolitical fears. Higher ed is also facing a massive structural financial crisis right now, leading to deep faculty layoffs and unauthorized endowment drains. The structural tailwinds are definitely separating the true market leaders from the casualties. Beyond those localized sector issues, we've got persistent macro risks threatening isolated volatility. First, we're tracking Strait of Hormuz volatility, which is causing intense fluctuations in Brent crude amid all the geopolitical tension. Second, AI cybersecurity threats are really escalating. After Anthropic's Mythos model showed some pretty advanced hacking capabilities, the White House actually called in tech leaders and slapped them with a 60-day cyber blueprint deadline. And third, the star manager trap. We just watched a $45 billion meltdown of a prominent AI fund. It's a stark warning that chasing big personalities over long-term market fundamentals is just a bad idea. Which brings us to Section 4, the dual economy. When you conceptually weigh these opposing forces, you can see massive, heavy blocks of structural momentum on one side of the scale. We're talking 35 to 40% earnings growth, a $60 billion retail de-risking, a surging ISM production index at 58.5, and explosive commercial leaps like Palantir's 149% growth. And those heavily overpower the smaller blocks of localized friction on the other side, things like the geopolitical volatility, persistent input costs, and regional construction halts. The synthesis here is undeniable. The market is definitively signaling that the massive scale of this AI infrastructure build-out, plus corporate resilience, is just vast enough to easily absorb those ongoing geopolitical and inflation shocks. Finally, let's wrap up with Section 5, upcoming market catalysts. Let's look at the timeline on the horizon to see exactly what's going to stress test this whole narrative. First up, we've got JOLTS job openings, which are forecasted to drop slightly to 7.4 million. Next is the BLS July jobs report, which is absolutely crucial for getting a read on manufacturing employment figures right after that huge ISM jump we just talked about. After that, you're going to want to keep a very close eye on SpaceX. They're releasing their first ever earnings report as a public company following their massive June IPO. Then we've got tech and pharma heavyweights stepping up to bat: AMD, Amgen, Merck, and Pfizer. And finally, the Commerce Department will drop trade balance and factory orders data. Every single one of these releases is going to seriously test the strength of our dual economy. So this leaves us with one final, absolutely vital thought to ponder. As AI infrastructure physically rescales the global economy, will the momentum continue to outpace the friction? I mean, the data says yes for now, but it's undeniably the defining question for the markets moving forward. Anyway, thank you so much for joining me for this explainer. Keep focusing on the structure behind the noise, keep learning, and I'll see you all next time.